So, okay. So this is a true life case study. I finished this particular job probably at the end of halfway through September. And the way it came about was accountant gave us a call, gave Chris and I a call, urgently. One would have been probably on a Thursday or a Friday, and said, look, a client had come and seen her, and the client was in a little bit of a mess because the bookkeeper that was working for this particular client had left, and had left sort of in a bit of a hurry. And of course, once I started digging down into sort of things that had actually happened within this particular organisation, it became pretty clear that it had some fairly major financial troubles that need to be dealt with. So to give you an idea of what those troubles were, this is a business that turned over probably around about $3 to $4 million. It employed over 35 staff. When you looked at the ATO portal, it actually owed the ATO $1.4 million, and a part of that, about $500,000 of that, was super. And I think those that attended the previous session, which I've given, tax office doesn't like outstanding super. So when they see outstanding super, and sometimes they get a tip off from staff members that either are there or have left the organisation, that their super hasn't been paid, and they'll ring the tax office up and they'll say, can you give us details of any super that you've got sitting in super guarantee that need to come to me because I can't see it in the super fund. And that generally then triggers an audit.
Okay. She's not in my line of vision. She's not there.
Yeah. Chris, do you want to see if you can mute that one, mate? Okay. Anyway, sometimes it triggers a superannuation audit, and that's what happened in this particular case. Super audit was triggered. The tax office were going to come in. This company is Trade Supplies, which is generally pretty much up to date. However, the business had been affected by COVID and the restrictions in Victoria. And it was a little bit of a mess. What we did find out was when the director printed out from MYOB the company's financials, in particular, I asked for a listing of all the creditors and the aging of those, and also a listing of their accounts receivable and aging of that. And once you actually went through all that, you found out that a lot of that information hadn't been kept up to date. And it was actually pretty difficult to get a bit of a handle on what the company's financial position really was. And it said that it owed a lot of creditors a lot of money, but the reality was that the director said, well, look, I've talked to all these suppliers all the time, and none of them have said that we owe money. And it was the same with their customers. When they spoke to their customers, they knew that the customers were paying regularly, but the records just weren't kept up to date. The one record that was probably kept up to date, however, was the ATO portal. And as I said, once you went onto the ATO portal, it became pretty clear that they had a serious problem with the ATO. So once we got to the position where we worked out that there was some really major financial strain on this particular company, sat down with the director and gave the director a number of options. And that's when you talk to us, we'll ask a whole heap of information. I'll put a little session on the back end of some of these, but we'll ask a whole series of questions, and the whole purpose of those questions is to try to get very quickly to the crux of where the problems actually are, so that we can then give some decent advice as to what options are available for that particular business and what the best options actually are. So the first option for this particular company was to try and negotiate a payment plan with the ATO. Now, the issue with that is, look, they probably would have got a payment plan. They had a deferral of tax. Bearing in mind the tax office were going to come in and do a super audit, so it'd be very interesting to see what they found as part of that super audit. And once the super audit's done, you're well and truly on the radar. But you could negotiate a payment plan, but the company didn't have, $1.4 million, and it wasn't probably going to get $1.4 million, even say over 3 years, to meet the obligations to the taxman. So whilst they probably got a short-term payment plan, somewhere down the track, it was most likely that it would default. If it did default, then the company's probably going to be in a worse position than if it did something different at this particular point of time. Another option, because of the restrictions and things like that, and a lot of businesses have done this over this period of time, is just do nothing. Just don't worry about it. I mean, you can't, companies can't get really wound up at the moment. The taxman's not really taking those steps to wind up companies at the minute. It is actually one of the major creditors that do wind up companies, but at this particular point of time, and probably well into next year, the tax office isn't taking that sort of action. Really, since the bushfires, there's been very few liquidations that have been initiated by the taxman by going to court and applying to wind up a company. So we could basically, the director could bury his head in the sand, hope it all goes away, think that there might be a whole heap of blue sky that's sitting there, and just delay dealing with the problems, kick the can down the road a little bit, and rely on the current insolvency restrictions that are in place until maybe next year, and then consider maybe doing something about it. That was an option, but it wasn't a great option. The director could place the company into liquidation, but as the director said to me up front initially, I've got 35 families that rely on this particular business, for their livelihood, and I don't want to see 35 families sort of out on the street because we can't afford to pay them. It's really important to us that this business survives and that I can support through the employment of the 35 employees and ultimately their families to remain in business and to keep their employment alive. So that was his major consideration. So liquidation was out. And then the final option was to enter into a voluntary administration and to put a formal proposal to creditors through a deed of company arrangement. Ultimately, that's the option that was chosen, and that was the best option because, as I said to the director, you're going to get a fair bit of sympathy at this particular point of time because there might not be a whole heap of companies that are going into administration and putting proposals to creditors. It's a pretty difficult period of time, and ultimately, it may very well be a good time to deal with the company's problems. You've only just really found out about them, and I know that you probably should have known about it earlier, but you're at least dealing with the problem that's sitting there. And a voluntary administration ultimately comes down to creditors as to what option is available to the company, and the future of the company is determined by the creditors themselves. Please, as I go through, if you've got any questions, either interrupt or just through the chat function, put something out there. Chris will grab that and ask the question. So what's the object nature of a voluntary administration? And there are really just two options that are really the reason for voluntary administrations. They were brought in a long time ago, back in '93. One of the largest voluntary administrations in this country this year has been Virgin. So it's used by companies of all sorts of different sizes. But basically, the whole purpose of a voluntary administration is to maximise the chances of a company, or as much as possible of its business, to continue in existence. And so what that means is voluntary administrations are very flexible in their nature. It might be ultimately that the business has to be sold, but it can be sold within the context of a deed of company arrangement. And if it's not possible for the company or business to continue, that it results in a better return to the company's creditors than it would result if the company was wound up or put into liquidation. So how does a voluntary administration start? So the general way it starts is by the director or the directors, depending on how many there are, passing a resolution at a meeting to appoint a voluntary administrator. Once that resolution is passed, a voluntary administrator is actually appointed. So generally speaking, what happens is that you as the accountant, the client will probably come to you. You'll say, gee, we've got some financial issues here, just like the example I gave you. We'll call us in, we'll have a chat to them, and then if it's appropriate, we'll say, look, I think voluntary administration is the best way to go. And then the directors call a directors meeting and will resolve to actually appoint an administrator. And at that particular point of time, the administrator is then appointed. So it's really, really simple. It's really, really quick. And that's what it's designed to do. A secured creditor, so some creditor which has got security over basically the whole or the majority of the whole of the, can also appoint an administrator. And from time to time, that happens. And there might be a variety of reasons why a secured creditor might do it, because what happens is that it preserves the company's business. It preserves it much better than perhaps a liquidation would, because it allows the company more options. It allows an administrator to go in there and have a look at the business, trade it on for a period of time with a view of trying to save it. And the third way, which is fairly uncommon, but I've had one recently in the last sort of 12 months or so, and that's where a liquidator can appoint a voluntary administrator. In that particular case, I was appointed liquidator of the company, and the company ran a cafe, and it also owned some residential properties. And the director really wanted to know how on earth he could continue to trade the particular business on. He wanted to put a proposal to his creditors, and ultimately the best way of doing it was through a voluntary administrator. So as the liquidator, I appointed myself as a voluntary administrator, and we put to the creditors a proposal for a deed of company arrangement, which they accepted. Now, this particular company had been wound up by Fair Work for underpayment of wages, and Fair Work ultimately voted in favour of the proposal, as did a number of the other creditors. So the administrator has a lot of power in terms of dealing with the company, but effectively that power, if you can think of it, the administrator becomes effectively like the director of the company. The directors themselves, whilst they're still the directors of the company, their powers cease. So they can't enter into any types of obligations for the company, and they can't really deal with any issues that confront the company without the administrator's consent or approval. So generally what happens in an administration is that the administrator will go in and we'll have a look at the business, and we'll try and put some controls in place. So we'll work out firstly, are there particular areas of the business that are underperforming? What controls need to be put in place for purchasing to make sure that the issues that a business faces, it might be, for example, that with the one I was talking about, where the ledgers, the debtors ledger and the creditors ledgers were out of date, try and bring them up to date as quickly as possible, try and recover as much money as possible, make sure the business is able to continue to operate in such a way that it operates profitably and you're not dissipating the assets. So pretty much administrator will go in. Now, when we go into a job, the best people to run a company are the employees and the directors. So as long as we've got controls that we've put in place, and it might be purchasing controls, for example, so we sign off on all the purchases, we're comfortable with the way that the business is being managed, and we take a role in that. We don't sit out of the business every day making decisions and running the business. We leave that for management to do, but with those controls in place so we know what's actually going on. So that's generally what happens in an administration. Administrator can dispose of property, Basically, administrator can do any power or function that a director can do. But one of the disadvantages, I suppose, of being an administrator is that any debts that are approved and incurred by the administrator is personally liable for those debts, but does have a right of indemnity over the assets of the company to pay those debts. So administrator's got to be pretty careful about incurring debts whilst running an administration. There's also a moratorium that's imposed on creditors, and what that means is that creditors can't take action against the company to try and recover debt. Their debts are sort of frozen in time at that particular stage, and that's to try and give the company breathing space to try and survive. So whilst they're at the stage where administrator is actually appointed, all debts are frozen at that particular point of time, and creditors can't take action against the company until the administration actually sort of comes to an end, and depending on what the outcome of the administration might be. The only exception to that is generally where maybe a creditor's taken action through the courts, and that action started before the voluntary administration has commenced, and that creditor goes to court and gets the court approval to continue with that particular action. So when administrator is appointed, there's 2 meetings of creditors that happen. So there's an initial meeting of creditors that happens within 8 business days of the appointment of the administrator. So a very, very short period of time. So effectively what happens, we get appointed, we work out who the creditors are, and we send a circular out convening a first meeting of creditors. Now that creditors circular needs to go out within 5 business days of before the meeting. So you can see that there's only a very short period of time that we've got to actually get all this information together. And in many respects, what actually happens in reality is that prior to being appointed, we will say to the company, okay, if you're considering appointing an administrator, start getting this information together, because once the administrator is appointed, we need to get access to who the creditors are, for example, so we can send notice of this first meeting out. Now, the first meeting, not much happens at the first meeting in most cases. So, but in some cases where you've got maybe a more complex administration, or you've got lots of creditors, the first meeting can actually be pretty active because all of a sudden creditors come to this particular meeting because they've been advised that the company's in administration, and they want to know what's going on. They want to know what the plans for the business are, what the administrator proposes to do. Will there be a deed of company arrangement at the end of it? And so really, apart from gaining some initial information from the administrator, and also maybe asking the director to comment on why the company is in the position that it's in, there are really 2 things that can happen at the first meeting of creditors. One is to actually replace the administrator. So sometimes that happens. Sometimes creditors aren't happy with the pick that the director has chosen. So, and they want to have somebody else actually do the job. And that generally happens where maybe the creditors don't think too much or too highly of the conduct prior to administration of the director, and have some concerns about that. Sometimes it's not necessarily a slight on the administrator that's in there, but they just think that maybe it should be somebody that maybe hasn't had any involvement prior to the appointment of the administrator with the company itself. The other one is to appoint what we call a committee of inspection. So a committee of inspection is there to help to advise the administrator on any sort of difficult issues that might come up. And in more complex administrations, a committee of inspection is something that's good to have. And give you an example, and I'm just sort of, it is an example. I don't know specifically what happened with Virgin, but you can imagine the different stakeholders that Virgin would have. So, for example, you might have the union, because you've got thousands and thousands of employees that are affected by it. You might have secured creditors, the bondholders, that they have an interest in the outcome of the administration. You might have trade suppliers. It might be your catering company, or it might be your cleaners, or there's a variety. Your fuel companies, again, all of who have a vested interest and probably have a lot of money at stake in relation to that particular company. So all those sort of parties can get together, and although they don't have any power to tell the administrator ultimately what to do, because that's the administrator's role at the end of the day, they can guide the administrator and provide some sort of feedback to the administrator on how to operate the business. So, for example, you might be trying to get a business up and running, and you need the buy-in of, say, the union and the employees. And so, rather than having lots and lots of employees sitting on a committee of inspection, you might just have the union representatives sitting on the committee of inspection, or you might have an employee representative. Same with the secure creditors and what have you. So committee is actually important in some cases. Then we have this big meeting, the decision meeting as we call it, which is the second meeting of creditors. So that happens within 20 business days after the appointment. That meeting must be convened, which in other words means it must be called. So, and then a short period of time after it's convened, it's actually held. So you can see that a voluntary administration basically goes for 4 to 5 weeks from start to finish, unless it's a complex one, in which case you can extend the period of time. But in most cases, that example, that case study I gave you at the start, we were in and out of that business within 5 weeks, with basically from doom and gloom, where the director didn't know really which way to turn, to having a proposal which had been agreed to by creditors, the business back on its feet and up and running, with it making a particular payment plan each particular month. But I'll talk a little bit about that later. So prior to holding this particular meeting, this decision meeting we'll call it, there's a very comprehensive report that goes out. So with that example I gave you, the report that went out to creditors was probably 80 to 100 pages long. Now, a lot of it it's things like remuneration, the proposal, but what it is, it details the administrator's investigations, it details what's involved in the deed of company arrangement, and it has a recommendation to creditors on what the administrator believes they should vote for in relation to the company's future. So what can creditors actually vote for? So there are, at the second meeting of creditors, creditors hold the power in respect to the company's future itself. So what happens is that if there's a deed of company arrangement proposed, then creditors will look at the report, and there'll be a comparison between the return they'll get under the deed of company arrangement and the return they might get if the company was wound up then and there on the spot, in other words, put into liquidation. And generally speaking, the administrator will vote or make a recommendation along the lines of what provides the best return to creditors. Sometimes there might be some other reasons, might be in the public interest, for example, that the company is actually wound up. But in the most cases, it's what the best return to creditors should be. So there are 3 decisions that are made by creditors, and they get to vote on one of these, and that is, firstly, that the company enters into a deed of company arrangement. So in other words, they accept the proposal that's on the table, or maybe a variation of that proposal. The second one, which is one that happens very rarely, and that is that the administration should end, because if the administration ends, then the company goes back to the directors in exactly the same as what it was before it went into administration. So in other words, with all those debts outstanding, so nothing's really been dealt with. Now, the only time when, for example, you might do that might be where, for example, at the moment you might have some clubs, poker machine venues or leagues, clubs, or what have you, that go into administration, and then someone comes along, it might be another club, and they say, look, we're going to pay out all of the creditors of the company as part of buying, say, all the shares as part of that, so we can take that club over, but we don't want the thing to go into liquidation, because if it does, that creates all sorts of issues with termination of contracts and so on and so forth. So in that particular case, it might be handy for the administration just to come to an end with an agreement there that all the creditors get paid out. And the third option is that the company get wound up. So basically, if there's no deed of company arrangement proposed, generally the company's wound up. And if there is a deed of company arrangement proposed, creditors really pick between whether the company should go into liquidation, or in other words, it's wound up, or whether or not they accept the deed of company arrangement that's on the table. Okay, so one of the other things that happens during an administration is that creditors can't take action against the company, but they also can't take action against the guarantors, unless, of course, that action is being taken before the company goes into administration, and it's also with leave of the court. And the reason for that is the legislation tries to allow for the alleviation of pressure on guarantors, who are generally the directors of the company, so they can concentrate on helping the administrator to actually try and get the business back on its feet, or do a proposal to give them the breathing space to do that, rather than to go and have to fight a whole heap of court battles from creditors that might be chasing them for a guarantee. What happens though at the end of the administration, so where after you've had that second meeting and it's either been voted that the company goes into a deed of company arrangement, or it goes into liquidation, creditors are then free to go and take action under a guarantee, and sometimes they do, in which case the director then might need to go and seek personal help themselves to try and get them out of that position that they're in, or try to negotiate with those particular creditors. So what does an administration generally look like? So when we get involved, if the business is still trading, we'll go and have a look at the business to see whether or not it can continue to trade. And sometimes it can, and sometimes it can't. And it just depends. I will say the earlier that somebody gets in and deals with the problem, the better the options actually are, and the better chance there is that the business will survive. So remember I said at the start of this presentation about the options that were available to that particular director. So they were do nothing, enter into a payment plan with the ATO, or put the company into administration, or put it into liquidation. So the director in this particular case put the company into administration, and because he did it early, there were a lot of options that were actually available. It gave the business the best chance of surviving. Whereas if he'd done it much later on, say if he did it in March next year, he might have used up capital that could be used to continue to operate that business. And it is important that there is capital available, and I'll show you the reason why that is shortly. So we go into a business and we get a very quick understanding of business and how it's actually operating and what its problems actually are, because the staff are very, very skilled in really cutting to the chase and understanding those key pressure points in the business. And some of those key pressure points, for example, might be, how do we get supply into the business? So creditors might have shut supply off. How do we make sure that critical suppliers continue to supply the business? How do we ensure that critical employees are still going to be there rather than just walk away from the company and resign? How do we make sure that we keep the customers? Because customers, they might get edgy and say, well, look, this company's gone into administration. you know, we're a government department, we don't want to deal with a company that's actually in administration, or we want to make sure that still get supply, maybe we should go to a competitor. So all those sort of issues come out very, very early on, and we have to deal with each one of them. We'll prepare cash flows and budgets to make sure that the business is profitable and has enough cash to survive. It's really important that a company does have cash flow to survive, because if it doesn't have cash flow, it can't pay its employees, it can't pay its suppliers, and it can't continue to operate. We'll look at the landlord, for example, as well. I'll make sure that the landlord's on board. Sometimes landlords, they get a little bit edgy, and will try and lock the business out. Now, legally they can't, but sometimes they just take it into their own hands and decide that that's what they're going to do. But in most cases, most landlords these days will have dealt with an administration before, or an administrator in one form or another, or they'll go to their lawyers who'll be able to explain what the law actually says in relation to that. So what we do is we talk to the staff, we get them on board, we look at the different areas of the business, we'll go walking around the business to make sure that we understand what the business actually does, and we'll go and talk to staff about the particular areas and any particular concerns that they might have, and things that they might suggest can be improved to get the business back up and running again. We might get rid of unprofitable elements of a business, and you know, sometimes in the bigger administrations that we do, you know, there might be a really profitable part of the business, and then there might be a really unprofitable part. You know, it might be that we have to just chop that unprofitable bit off, and there's no better way of doing it whilst the company's actually in administration itself. Day one, we get an OH&S assessment done, because an administrator, as I said, is like a director. So if someone goes and lops their hand off in a machine that doesn't have a guard on it, the administrator is responsible for that. The administrator is responsible for the safety of the people that work there, just like a director would be. I remember going into a company once as the administrator, and it dealt with big mining tools, you know, things that go on, you know, things that bore into the ground to create massive tunnels, like in the train system. And so it had a tool from one of these big boring machines, which was probably, you know, 4 stories high, and there were people up on doing work on this particular. It was like a ring, effectively, on ladders. And OH&S person is probably the most important person. We get them out. So if we're appointed at 9 o'clock in the morning, by 10:30, 11 o'clock, the OH&S assessor's out there having a good look at the place. And so the OH&S assessor came out, and the first thing that assessor did was look at that work that was being done on that particular tool, and said work needs to stop immediately on that. No further work can be done on that particular job until you get scaffolding put right around it so people are safe. So that's what ended up happening. A couple of days later, the scaffolding was out, was all up. The OH&S assessor came out, had a look at it, gave it the green light, and we're able to do work back on that particular item. So they're the sorts of things that actually happen. Again, we need to make an assessment as to whether management is capable of running the business, and in 9.5 out of 10 occasions, management and the staff are the best people to have in place to running a business. We don't want to be on site day in, day out running a particular company, because you know, it's best run by those that actually know how it all works. In the case that we had with the case study, one of the issues that was that the business hadn't applied for JobKeeper. And if the business had applied for JobKeeper, it would have got about $80,000 a month out of JobKeeper since April. So we applied for JobKeeper, got all the stuff in. Unfortunately, we couldn't get it retrospectively, but we certainly were able to get it onto JobKeeper for the time that we were actually in. And you know, it's actually doing really, really well, that business now, because fundamentally we made the assessment that the business was good. It just was riddled with debt, that need to be dealt with. So one of the things that we do is, and with that case study, we look at how we actually formulate a deed of company arrangement. Now, generally speaking, it's the director or the shareholders that put up a deed of company arrangement, but anyone can actually put a deed of company arrangement up. But generally speaking, with the smaller businesses, SME businesses, we'll work with the director to actually formulate a deed of company arrangement. And it can be really flexible, a deed of company arrangement. It can be, for example, the director might be able to go and tap family and friends to put a lump sum amount into the business to be made available to creditors. It could be a payment over a period of time out of profit, and that period of time is flexible. It could be 3 years, it could be 5 years. It really is very flexible about what the proposal is. But by working with the administrator, generally, because we've got a lot of experience in dealing with these sorts of proposals, we know what works and what doesn't. And to give you a bit of an idea of that, let's say the director or relatives are owed a substantial amount of money. So let's say out of a couple of $1 million, let's say the director and family members might be owed $800,000. So rather than them participating in a dividend that comes out of the deed of company arrangement, it's best sometimes that they don't participate at all, which means that it allows more money to go back to the other creditors, and it's much more attractive because if they don't stand back, then they will form part of the creditor pool and will also get money that comes out of the deed of company arrangement. So it just makes it more attractive sometimes if they sit back. Now, it doesn't mean that their debts don't exist anymore. It's just that they don't participate. They're not, they can still claim money. Once the business is back on their feet, they might get their money back that way, or maybe after the deed of company arrangement has been paid out. So in the report to creditors, we'll report to creditors as to whether or not it's in their best interest to accept the deed of company arrangement. And generally speaking, in a lot of cases, unless there's real concern by the creditors, the deed of company arrangement recommendation by the administrator is generally accepted a lot by creditors. Where it's not accepted by creditors is where maybe the director just hasn't done the right thing by the creditors themselves. And some of those things, if you remember in the previous presentation that we gave, will be things like maybe not responding to creditors, just telling them that they're going to get paid and they never get paid, and creditors not providing their level of support for the business itself because the director hasn't done the right thing by them. But in most cases, the directors do the right thing by creditors all the way through, and for various reasons, they're in that position. And you generally find that in most cases, most creditors are pretty sympathetic. So in the case study, what did the deed of company arrangement actually look like? Well, what it looked like was a payment each month of $12,000 over a period of 3 years. Bear in mind the tax office was owed a lot of money. What the tax office likes to see is that the tax lodgements are all brought up to date and are kept up to date. The director would actually contribute some money, so $50,000, okay, and the employee entitlements, which is the superannuation, that at the end of the day, that superannuation would be paid in full. So it would be paid out of the contributions that were actually made by the company itself. Now, you might say, well, that doesn't sound like there's enough money there to pay those. Well, what we did find was that whilst there was probably $400,000 to $500,000 that had slipped into super guarantee, the company had in fact been making contributions for the last sort of 18 months to the employees' superannuation funds. And so there's a big reconciliation effort at the moment going on, where we're trying to work out really what the true debt is, and we suspect that the true debt is probably somewhere around $200,000 to $250,000, so rather than $500,000. So that was a proposal that was put to creditors, and most creditors were very supportive of this company, particularly the trade suppliers. They were very supportive because, the guy had done his reasonable best. Not many of them had too many debts that were outstanding. It was really just the tax debt that was outstanding for quite a period of time. So in that particular case, the tax office voted in favour, and all the creditors also, in the most part, I think there might have been one or two that voted against, but in the most part, all the creditors voted for the deed of company arrangement. We got out, as I said, within about 5 weeks, and that business has been handed back to the director, because that's what happens at the end of an administration. It gets handed back to the director, and all the director's got to do now is comply with the terms of the deed. So we're still sitting there for the next 3 years, but only in the capacity really of collecting the amounts that are due under the deed that's been proposed, and then distributing those monies back to the creditors. Looked at the return to creditors and compared that to liquidation. The comparison was creditors could get potentially somewhere up to 40 cents in the dollar under the deed of company arrangement, and under liquidation probably something less than 18 cents in the dollar. So it was certainly a much better return to creditors than the deed of company arrangement. And that's what the benefits of an administration are, because it maximises the return to creditors. It prevents a single creditor from taking action against the company to the detriment of all creditors. So sometimes what happens is we get people that come to us and they say, oh, why can't we just negotiate with all our creditors? Because what ends up happening is you might have a dozen creditors that are there, and you might be able to do deals with 10 of them, and then it's the last 2 that you can't create deals with. And because you can't do a deal with them, it means that basically all the other deals, just don't go ahead, because ultimately what happens is one creditor will find out, oh, you've done a different deal with another creditor, and they'll say, well, I'm not going to enter into that deal. I mean, you can just pay us in full. Otherwise, we're going to take action to wind you up. Some of the other benefits, early action is really the key to this. The earlier the action, the better the outcome. And it's the same with everything that we do. Ultimately, if directors talk to us really early on, they have much more options than if they're about to get wound up in the court, or the company's about to get wound up, and ultimately they then need to do something that's pretty drastic to stop the company from being wound up. Options are very limited at that particular stage. And it enables a restructuring of the balance sheet. And part of what I mean by that is the liabilities, they're all sort of quarantined, I suppose, for want of a better term. They're all covered by the deed of company arrangement. And it means effectively that the company has a very clean balance sheet. It's got some working capital to keep on going. It's got a viable business. And sometimes by dealing with that big debt problem, that allows, through a deed of company arrangement, that allows the business to survive. It gives it breathing space to get back on its feet again. And that's really what it's all designed for. Some of the other things that you can do is you can lop off unprofitable components in the business. You can get rid of some unprofitable contracts and things like that, and you can try to it's a good basis on which to restructure a business as well, particularly where you might not be able to do that because the company just doesn't have the ability or the capital to do it. So it really is where we see voluntary administrations as being very useful is, you've got your typical client that comes in, got a good business, but what's happened is they haven't paid their taxes during COVID. They owe a fair amount in tax. They probably have had a deal where they've got a deferral with their landlord, and they're going back to full rent from the 1st of January, but they've still got to try and meet a fairly large obligation to the landlord over a period of time. And they might also have those issues with suppliers as well. And in the old debt that might be sitting there sort of, maybe pre-COVID that they haven't been able to pay. So, in those sort of situations, it's a good way of actually dealing with the debt there if there's a good underlying business. And if the proposal is a good one and better than a liquidation, there's probably not too many reasons why creditors from a commercial point of view shouldn't accept that particular proposal. So that's the end of the presentation. I'll unshare my screen now, but happy to take any questions about voluntary administrations. Okay.
Chris speaking here. A couple of people, Haroon and Greg, turned up late. I can send a copy of the presentation. Sorry about that. To them. So if anyone else would like a copy, please send me your details and I will send it off to you.
So yeah, we welcome the opportunity to talk to you about any issues that you or your clients might face. As always, there's no obligation in relation to any of it, and what we try to do is just ensure that we just give you proper advice as part of that insolvency arm of your particular business. So in a lot of cases, your clients won't need to go into liquidation, might not need to go into administration. They might just need some assistance, for example, maybe in dealing with a landlord or dealing with a financier. And we can offer that sort of advice. So it's really trying to match up the right advice for the sort of circumstances that actually exist.
Chris Drupas has asked a question. Are
Sure.
there any legal ramifications for accountants advising on the turnaround solutions?
You've got to be very careful in advising on turnaround solutions because you don't want to be held to be aiding and abetting. So there's aiding and abetting laws that are out there, and in some cases, accountants can get caught up in that type of situation. You best. Some things I think you can probably give advice on. Restructuring is a very, very specialised area, particularly when you're getting into maybe sale of business and assets and restructuring and maybe into a related entity or what have you. You've got to be very, very careful as an accountant that you're not doing or suggesting things that maybe go against the law ultimately. And yeah, it's a difficult area. There's no such thing these days as I think, well, in my view anyway, asset protection. Yes, there is some things that you can do or your clients can do, but in the most part, the laws have been designed so that a liquidator or a bankruptcy trustee can get access to assets that should ordinarily have been available to creditors. And so you've got to be careful. If you've got skills in that area, then it's fine. If you don't have skills, you like everything else, you're probably best to get the experts involved. You like giving a complex tax advice. If you don't have the necessary skills in that particular area, you're probably always best to go to a tax accountant or lawyer to get that specialised advice, and then you keep yourself out of trouble. Hopefully that answers the question. Anything else? Okay, well, if there's nothing else, again, thank you very much for allowing us to speak to you today and for sharing a part of your day with us. And as I said, if we can help out in any particular way, please don't hesitate to contact either Chris or myself. You're muted, Chris.
Thank you very much.
Thanks,
You'd like
guys.
to hear me a bit more often, I think. See you. Take care.
See you. Cheers. Oh, and if you're around on Thursday, you're welcome to come to our next Red into Black seminar on sale of accounting practices and buying accounting practices and what have you. Okay. Thanks, Chris.
Okay. Thank you.